Want to be invested in a world-class business that operates within a global oligopoly? Like the idea of a market-beating yield and double-digit dividend growth from a Dividend Aristocrat? Looking for a great dividend growth stock that's on sale after a 20% plus drop? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a global provider of industrial gases. Industrial gases are crucial input for a variety of manufacturing processes. Cheap input, but necessary input. And so manufacturers usually sign long-term contracts with one of only 8 global players in order to make sure there's a steady and reliable stream of gases. Necessary, long-term contracts, oligopoly. That sounds like money to me. Indeed, this company just continues to grow its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Air Products and Chemicals Inc., which appear to be trading at a significant discount today. Air Products and Chemicals Inc., stock ticker APD, is a major global producer and supplier of industrial gases. They're the largest supplier of hydrogen and helium in the world. Founded in 1940, Air Products and Chemicals is now a $55 billion by market cap industrial gases juggernaut that employs over 20,000 people. The company's fiscal year 2021 sales were reported through 4 industrial gases business segments organized by geography. Americas 40%, Asia 28%, EMEA 24%, and Global 5%. Corporate and other accounted for the remaining 3%. Air Products and Chemicals has a terrific business model. Industrial gases are critical input for the manufacturing processes of many different end products ranging from electronics to vehicles. Because of the critical nature of these industrial gases and because constant reliable access to these gases is a must, a manufacturer will set up a long-term contract with a dependable provider of these gases. Complex infrastructure is then installed at a manufacturing site to ensure reliability, which makes it costly and difficult to switch providers later. If all of that weren't already great reasons to own a slice of the business, Air Products and Chemicals is part of a global oligopoly. 3 major companies in the space occupy the vast majority of the global market share. Air Products and Chemicals combines necessary input with long-term contracts fortified by complex infrastructure within the favorable confines of a global oligopoly. This company basically cannot lose over the long run. It's hard to imagine any future world, decades down the road, in which they're not producing substantially more revenue and profit and paying out a much larger dividend. As things stand, the company has increased its dividend for 40 consecutive years. They easily qualify for their status as an esteemed Dividend Aristocrat. The 10-year dividend growth rate is 10.1%. I'm always happy to see a double-digit long-term dividend growth rate, and you're pairing that growth with a starting yield of 2.7%. This yield handily beats the market, and it's also 50 basis points higher than its own 5-year average. The payout ratio is 62.9% based on midpoint guidance for this fiscal year's adjusted earnings per share. That's slightly elevated, but but not worrisome. It basically sets them up to grow the dividend roughly in line with the business. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or higher dividend growth rate. This yield is on the lower end of that range, but the high dividend growth rate makes up for it. Great dividend metrics. Looking at business growth, Air Products and Chemicals advanced its revenue from $9.6 billion in fiscal year 2012 to $10.3 billion in fiscal year 2021. That's a compound annual growth rate of 0.8%. You'd be forgiven for being disappointed in this number. However, the limited top-line growth over the last decade is actually by design. The company made a decision to purposely make the business smaller and more efficient through their quote-unquote 5-point plan. This plan focused operations on industrial gases by jettisoning non-core businesses. Executing this plan led to spinning off the Electronics Material Division in 2016, and then they sold the Performance Materials Division in 2017 for $3.8 billion in cash. I must say, it's worked out pretty well. Earnings per share grew from $5.44 to $9.43 over this 10-year period, which is a compound annual growth rate of 6.3%. It's important to point out that most of this growth started to reveal itself after fiscal year 2016, which is when net margins started to increase dramatically. The company is simply doing much more today with what is effectively the same sales base from 10 years ago. This isn't a function of big buybacks either. The float is actually up slightly compared to a decade ago. Also, it's worth pointing out that the company's GAAP earnings per share can be lumpy. In my view, the company's true earnings power is better than this mid-single digit bottom line growth rate would imply. It can be instructive to instead look at adjusted earnings per share in this case. Indeed, the company's guidance for adjusted earnings per share for this fiscal year at the midpoint is calling for 14% year-over-year growth. Looking forward, CFRA believes that Air Products and Chemicals will compound its earnings per share at an annual rate of 15% over the next 3 years. CFRA's forecast for earnings per share growth would be more than twice as high as what Air Products and Chemicals has delivered over the last decade. Is this crazy? I don't think so. Keep in mind, most of the last decade's earnings per share growth came about after the transformation. An acceleration in growth is playing out here. Moreover, again, I believe that the GAAP earnings per share number often doesn't fully communicate what this business is capable of doing. The business is structured to succeed based on providing high value but low cost gasification. Long-term contracts get locked in when huge projects begin, and this is all occurring within the favorable structure that is a global oligopoly. This is an extremely powerful and compelling setup, and there's no shortage of work here. CFRA highlights this, and I quote, "We think APD has a solid backlog of growth projects with a focus on expanding the scope of syngas supply agreements, acquiring air separation units, and winning agreements in large industrial gas projects," unquote. They're not exaggerating. The company's total backlog is over $18 billion. In addition, new growth avenues that didn't even exist 10 years ago are just now opening up for the company, which further supports the growth acceleration thesis. CFRA adds color to this point. Again, and I quote, "APD is well positioned to capitalize on gasification related to carbon capture and hydrogen mobility, which are long-term secular tailwinds," unquote. There's also the green hydrogen story. The company's $5 billion partnership with Saudi Arabia's ACWA Power and NEOM on the world's largest green hydrogen plant in Saudi Arabia is a prime example of this. We're basically taking what was already a very good business 10 years ago, improving it through renewed focus on its core strengths, and then adding on new growth vectors. This is very exciting. If Air Products and Chemicals is able to grow its earnings per share at a rate that's even close to what CFRA is projecting, the dividend should be able to rise at least at a high single-digit rate over the foreseeable future. When you're already getting a 2.7% yield to start off with, I find that to be rather appetizing. Moving over to the balance sheet, the company has a great financial position. The long-term debt-to-equity ratio is 0.5, the interest coverage ratio is over 18. Profitability is strong and improving, especially in the margin department. Over the last 5 years, the firm has averaged annual net margin of 21.5% and annual return on equity of 18.6%. Adding some perspective to the margin expansion story that I touched on earlier, the company was routinely printing single-digit annual net margin prior to fiscal year 2017. There's almost nothing to dislike here about this high-quality Dividend Aristocrat, and the business is protected by durable competitive advantages that include global economies of scale, high barriers to entry, heavy switching costs, a global oligopoly, and long-term contracts with fixed infrastructure. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Demand for industrial gases correlate with manufacturing activity. Any large-scale economic downturn would impact the business. Air Products and Chemicals is involved in a variety of major energy projects around the world. Continued evolution in the global energy complex adds risk to this part of the business. Input costs can be volatile. More than half of the company's sales come from outside of the Americas, which adds currency and geopolitical risks. These risks should be considered, but I find them to be quite acceptable when weighed against the quality of the business. And with the stock down more than 20% from its 52-week high, the valuation makes it particularly compelling right now. The stock is trading hands for a price-to-earnings ratio of 24.4. This compares favorably to its own 5-year average of 29.1. The sales multiple of 4.8 is also off of its own 5-year average of 5.4, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. I'll admit that this is as high as I'll go when modeling in a long-term dividend growth rate, but I think this business deserves it. Their long-term dividend growth rate is well over this level, and the near-term forecast for earnings per share growth is nearly twice as high as this. I'm not saying they'll blow the doors off with growth, and the days of double-digit dividend growth might be limited, but I fail to see why the business can't grow the dividend at a high single-digit rate over the long run. For reference, the most recent dividend increase, which was announced earlier this year, came in at exactly 8%. The dividend discount model analysis gives me a fair value of $349.92. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time valued money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Air Products and Chemicals as a 4-star stock with a fair value estimate of $317. CFRA rates Air Products and Chemicals as a 5-star strong buy with a 12-month target price of $324. I came out on the high end, but we're all in agreement that the stock looks to be worth much more than it's currently being priced at. Averaging the three numbers out gives us a final valuation of $330.31, which would indicate the stock is possibly 34% undervalued. Here's the bottom line, guys. Air Products and Chemicals Inc. is a high-quality dividend aristocrat with great fundamentals that operates within the friendly confines of a global oligopoly. Their industrial gases are cheap, but critical input that force favorable long-term contracts. With a market-beating yield, double-digit long-term dividend growth, a reasonable payout ratio, 40 consecutive years of dividend increases, and the potential that shares are 34% undervalued, long-term dividend growth investors ought to seriously consider this name right now. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, is at it again. After reporting great Q2 numbers, including nearly doubling revenue year over year, they raised guidance once more. This comes after the company already boosted guidance twice in May. The company raised fiscal year 2022 guidance for adjusted earnings per share of $19.25 to $22.25, $12.30 to $15 previously. I've highlighted Albemarle countless times as the way for long-term dividend growth investors to play lithium. Don't forget about it. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.